CPI comes out better than expected. We're going to go through the numbers. The S&P continues to rotate and push. We can see in here in dark blue how the Russell was leading. You can just kind of see how the Nasdaq and the S&P were faring for the day and how we finished here. So on a performance basis, we're seeing rotation. We'll explain why that's good. AMD plummets on its call today. We'll explain why they plummeted and why NVDA actually went up on the AMD call. To follow up on our Tesla call yesterday, we talked about how we had to clear a certain level. We cleared it. We're going to talk about what's next. The squeeze continues in certain names and probably is going to continue for a period of time. We're going to explain why. Let's get to it. Hey everybody, welcome back. We have a lot to go over, so we're going to jump right into it. We can all see the peak right here from August. We can see the peaks right here and how we finally cleared them. And then we can kind of see the breakout right here from that flag. We talked about this about 2 weeks ago, or about a week ago actually, on this break, the consolidation. I think this is really important, the levels of consolidation that you're getting in here and what it's going to mean going forward. And we're going to get into that. But I think it's most important to just say, okay, what is happening in the grand scheme of things? In other words, is this sustainable and why? My opinion is that it is sustainable if we rotate. Straight up is not a pattern, as I'm used to saying, but if we rotate, this can continue. Now here's your break and here's your line. So one of the key things that I keep hearing about is, oh, we're going too high, too fast. And I just want to explain to everybody, and I'm sure that the majority of people get this. Let's just drop this right here and come across. And if you just look at these dates before you have your first breakout right here, you have 181 bars or 261 days of trading in a base. And then you have your breakout, like your real breakout here, not one of your, fake, we're going to lure you in and then whack-a-mole you, but your real breakout, okay? 261 days, 181 trading bars. All right. It's been 1, 2, 3, 4, 5, 6, 7, 8 days, and people are already trying to throw in the towel saying, oh, it's too high now. All right. So very simple saying that they have in the industry, and there's a reason they have it. Okay. The bigger the base, the bigger the breakout. Historically, you can measure your base and your breakout by the same amount of days. So if this is your base, then your breakout should be corresponding to that, right? That's kind of how you're supposed to look at it. Now, of course, that is not a straight line. Straight up is not a pattern, but you need to keep that in count. And what they need to do is they just need to keep rotating. For example, you look at XLF and you can see the breakout right here, 32, and now we're pushing towards a major resistance. One of the names that we bought in the Alpha Chasers community that just looks like it's going to be a complete face ripper is this GS. I really like Goldman for a number of reasons. To me, they're pretty much the standard when it comes to research. But you start looking at this and then just overlay the simplest of indicators. And it's really hard not to get excited about this. You came up, you couldn't make a lower low. Now you're making a higher high, closing at a higher high, stopping at a certain level. And then on top of that, look at your RSI. And for those that don't use RSI, don't use it. But as I like to say, you have to look at these tools as it depends on whose hands they're in, right? Certain tools will work well for certain contractors and certain tools will not. But if you take a look at what's happening here, you can really see the positive divergence, and this is setting up. And then you have this DTL, as we refer to them, the downward trend line for those that aren't aware. You can see that it's pretty clear shot to 360 there. This is a W pattern. So I think this will push. It's one I'd have on your radar. You're going to have the Fed tomorrow. We will be live for the Fed, so make sure you subscribe to the channel so you're notified. We'll go live before it, and we'll stay for Powell's speech, and we'll talk about what he's saying and the ramifications of that going forward. As we stated on this morning's pre-market live call, core CPI came in right in line. That is with food and energy extracted out. When it says core, there's no food or energy in that number, which is kind of silly. I mean, they're the things everybody needs. Then you come to CPI month over month, and you can see where you're at, and you can see the drop there, right? Now, this is staggering to me. CPI year over year, I'll tell you why it's staggering. A month ago, we were at 4.9. That was your first break of 5. So the last time you had double-digit CPI, and we were darn close to double-digit CPI, was 1983. I would suggest that you go back and take a look at what happened in 1983 and how we reacted when we went from double digits to under 5%. I understand that this time is not exactly the same, but there's a lot of reasons why it's better in my opinion. Either way, you went to 4.9, you were at 6, you're now at 4, okay? it's not a question of whether or not inflation is over. It's over, right? And if you're not getting that as we plummet down about 15–20% in inflation month over month, there's not a whole heck of a lot I'm going to be able to do to explain it. Bottom line is inflation is dropping, prices are coming down. It is pretty much obvious to everybody at this point. One of the graphs I went over this Saturday, and what I try to do on the weekends is give you the things that you should be looking at. But one of the things I tried to go over Saturday was just explain what's happening. So this is inflation surprises measured. It's JP Morgan that came out with this data. And what they're doing is they're measuring the US and global CPI, and they're measuring the times that it comes out and whether or not it's surprising or not surprising. Simple enough, right? And you can see the pandemic, and obviously we're going to be underwhelmed during the pandemic. And then when things got hot and everybody was buying $1 million JPEG, you can see that we got a little ahead of ourselves in here. And you can kind of see how the US peaked first, and then you can see how global peaked after that, right? Well, what's happening now is you're getting to a point where you're getting negative surprises instead of positive surprises. And that's a big difference. And we saw that today. We had another negative surprise. So it is pretty clear that inflation is coming down. Now, it's going to be very hard for him to raise rates even in July with what we're seeing. Now, this is a Fed Watch tool. This is from CME Group. Anybody can go and watch this. It is absolutely free. If you remember when we showed this earlier in the week, meaning Saturday, this reading was at 70%. It's now at 92%. So the chance of raising rates tomorrow is 8%. Nobody thinks that's going to happen. Now, let's be really clear. Let's say that Jay Powell decides to raise rates. Equities will get hammered. Okay, just be very clear about that. If they raise rates tomorrow for any reason, equities will get hammered on that. Okay, would be completely unpredicted that he's going to do that with the news that came out today, very clearly. And if you think that they're not watching CPI today, you're wrong. They're watching everything. And I think this is really telling. Here we are again at that 5, 5.25, and they're still talking about a rate hike. They're still talking about a rate hike. They're talking about a 50 basis point rate hike there and a 20 or a 60% chance in July. Now, why that's so fascinating is because when we went out to December and we were looking out to December, look at this and the difference, right? So they're going to hike, then cut, then hike. I mean, it's kind of loony what's going on out there right now when you start looking at it and you start looking at these percentages. So they're going to rate cut, or they're going to rate hike up to here in July, and then in December, not so much anymore, right? Like it's absolutely silly. So see, if you look at this 4.4%, I'll show you where I'm going with this. So the chances in July of it being 5%. So he's going to hike up to 50 basis points in July, but by December, the chances of it still being the same number is less. It's absolutely silly, and it just shows the amount of division out there with what's happening. It's funny, as we were talking, this just changed a little bit, about 0.2%. But the bottom line is this is your target. Anything off of that, we're going to have a problem. We're going to listen to his language tomorrow and see what happens. If he raises rates, equities will sell down. That is my opinion. It is very hard for him to justify that with inflation plummeting. I mean, what he should be doing right now, if I was him, is taking a victory lap. Okay, so what if he can pull off a soft landing? I don't know if he's going to or not. Let me be really clear about that. But right now, he should be taking a victory lap. Now, why is this market sustainable? This is sustainable because we are rotating. Now we are seeing breakouts of small cap names. Nobody wanted small caps 2 weeks ago. Now everybody's clamoring for them. This is something we bought in the community a couple days ago. It was pretty clear how we were setting up on the break, and we're doing okay with it. We're up a couple dollars in it, but just the way that this is setting up and the ability to, move the stop up now and hold on to something like this, it just gives you so much credibility in the ability to manage that trade, right? Like you feel better about your trades when you're in at the right entries. So you don't really want to chase these. You just want them to set up. Now, to me, this is not chasing, right? Like if you're not in something like this and you don't have the best price, you still look at that low and go, okay, well, maybe that makes sense. Maybe it doesn't. But you start looking at this volume and you start looking at what's happening out there. 15.9% is regionals and financial services. They seem to be getting their act together, don't they? So let's see how long that's going to last and if they're going to get their act together or not. But it sure seems that way. A lot of people in the room are playing this DPST. I am not playing it, but I sure as heck understand why they are. and it makes a lot of sense. For me, I've been playing more with the AI names and the shorts that are, there's a lot of panic going on out there in names like this, AI, these kinds of things. I don't know why somebody would want to be in a short where 30% of the float is short. I'm not really sure what the rationale is there after you just watch people get destroyed. For those that are still shorting these names, I don't know how to explain this any clearer. You are not in a bear market. So if you're not in a bear market, then you have to realize if you're not in a bear market, you're going to get inflows into equities in the market. If you get inflows into equities in the market, it doesn't matter what the name of the stock is. A rising tide lifts all ships, right? If ARK got money and ARK was buying AI, I'm not saying that they are, but let's just say some other fund was buying AI, right? And they're getting inflows, they're just going to buy stock. I mean, it's those inflows that drive the stock. It's not retail, it's not FinTwit, right? So just keep that in mind. There is no catalyst here that you have if you're short this. What's your catalyst? That it's not going to make money, it's not going to be significant. Do you know how many companies in the 90s went up, doubled, tripled, went 10x that weren't significant? So I'd recommend listening to Druckenmiller's talk on this about shorting companies that he knew were bankrupt companies and how he lost $400 million. So you need to be really careful if you're shorting this stuff. It can go against you. It can be extremely painful. I short very little in this kind of environment. Once you're in a bull market like you are right now, I very, very little of this do I short. And if you don't think you're in a bull market, I would go and take a look at the charts. Nasdaq continues to rally. You can see from 2023 on how we've been doing. Just to put this into perspective, for those that want the super technical definition, once you're above 20%, you are out of a bear market. So you've been out of a bear market since about February, and you can see very clearly here from soup to nuts, you are 44.78% from the bottom on the futures market. Very hard to not tell yourself that you are in a bull market. I don't know what else people are going to really want. That does not mean you're going to go straight up. As I've explained before, you no longer have the Fed behind you. You don't have $1.7 trillion out there buying bonds, buying equities. This is a good thing, and I'm going to explain why. It will create real volatility, and you as a trader can make money off real volatility, and I'll show you what I mean by this. Now, today we had the AMD conference call and their presentation, and we'll get to that. Now, this is what happened when AMD started dropping. Now, the beautiful part about this is without that backstop in money, you don't have the same supply of money out there. If you don't have the same supply, when something moves, you're just not going to see that demand step in, right? Because you don't have the same amount of capital. What that does is it creates more volatility. This reminds me a lot of really the mid to late 90s. And 1 minute the stock's at 410, next minute you're at 401. And it's just because they're selling and there's nobody there to buy. They're just letting it drop. This drops, bounces, comes back, and just rips. And that's understanding what's happening here. And you're able to take advantage of these sells. You're able to take advantage of this if you understand why this dropped and why it was silly that this dropped. This dropped because AMD dropped. It became apparent in this conference call today and their partnership with Meta. This is what I'm going to call their $4,000 goggle moment, because we saw what happened with Apple. But you see this right here, and you see how we didn't bounce back the way NVIDIA did? It became increasingly clear when this happened that AMD is not competition for NVIDIA, that they do not have the same level that NVIDIA has, and nor are they on target for it. And that's what people were looking for today. Instead, they got some corroborations and things like that. Nobody wants to hear that. They want to hear, how are you going to compete with NVIDIA? And the answer is, they're not. Now, if you look right here, you see that break, and you can clone these. Always want to clone them. That's why that button's there. And you want to put them in here and just see where they lie, because it shows you the trajectory. And you can see that you have this bear pendant here and how you broke that pendant, and that was the end of it, right? So will this continue to go up? A rising tide lifts all ships, right? That's one of the reasons why I even said I don't want to be short a lot in this market. You can short these, you can play the game and pull money out. I'm not saying it won't work. I'm saying it's not optimal for me. It doesn't mean that it won't work for someone. I don't want to trade that way. The way that I want to trade in this environment is very different. I trade by looking at names like NVIDIA and constantly build positions in these names over time now and swing trade them. That's how I do well. This is actually my exact kind of market, what we're going through right now, because I have disbelief and I have a sector that's on absolute fire that has the potential to change things that we haven't seen in possibly 2 decades. So as we're seeing these moves out of these, I'm in no hurry to get out, but I certainly don't want to be out there trying to get $5 or $6 out of AMD on a move if I think NVIDIA in 3 years is going to double. It's just not worth my time anymore, right? So the game changes. As the game changes, we need to adapt or die, right? So that's kind of where my head is, and that's why those kinds of moves don't do it for me right now. If we were in a tough penny environment, we're trying to hit singles, that's great. You're not in a tough penny environment. You're in a technical environment, and you better know the fundamentals of these companies, or you're going to have a really tough time. And the people that I'm talking to, they're not getting the fundamentals of this yet. So as that develops, these stocks will start losing that edge. Right now, there's tremendous amount of edge for people that actually understand the differentiation between NVIDIA and AMD. And that can be seen pretty clearly today. Now, just to put this in perspective so you can see, this is the AMD in blue, and you can see what happened. This is NVIDIA in orange, and you can see what happened. As it became increasingly clear that AMD was not competition for NVIDIA, people sold AMD. What did they do? They bought NVIDIA. Okay, so tomorrow what you're going to see, and I'll tell you now and save everybody a lot of time, you're going to see investment banks come out tomorrow and talk about NVIDIA and that AMD does not have a competitive edge. Okay, that's what you're going to see, but they're going to talk about AMD in a nicer light. But the reason that this happened is because the competitive edge goes to NVIDIA. I've explained this a little bit. I'm going to take a second and explain this again because it's really important. So you have this line right here, okay? And we'll make it big like that. We're going to say this is the top of the stool, and then each stool has legs. Here's your macro leg, okay? The macro leg of this entire move that we just had over 18 months, we're not going to be putting our weight there anymore. We're going to be putting our weight more on the fundamental side of the market, okay, and understanding the fundamentals of individual names. That is going to be a huge component, and I can tell you, and I'll show you why I'm saying this. And then you have this right here. I'm actually getting better with this stool drawing. If you think my drawings are getting better, comment below. Anyway, you see, actually this is awful. It's not even lined up, is it? Jeez, don't comment on the stool. Anyway, so you see where your technicals are right here, and then here's your fundamentals. So if you're on here and you're sitting, right, sometimes you're going to shift and be on macro. Sometimes you're going to be here, right, on the fundamental side. And sometimes you're going to be all technicals. I'm telling you, the people that are going to really clean up in this market, and we're seeing it in our community already, are the people that understand the fundamentals, go after those names and overlay them with the technicals. Forget this, okay? Unless Itchy raises interest rates tomorrow, we're not going to really be paying that much attention to it, right? You still have to know it's there. You still have to pay attention to it, right? But not to the same weighting that fundamentals are going to take place. And I'm going to say that I think the fundamental weighting right now is actually going to even overtake the technicals. I think that's why we could actually stay in overbought conditions, because people are not going to truly understand the technicals. And what do I mean by that? What I mean is that this stock went up to here, NVIDIA went up to here from here. Earnings were so great that they are 18 months ahead of schedule and making $11 a year. They're going to start this quarter on that run when they weren't supposed to start for 2025. That is an enormous difference. Now, what does that mean? It means that they're looking at $18 instead of $11 in 2025. Goldman came out when this happened and told their clients that the stock now, even though it's up 20%, is actually cheaper based upon their metrics than it was before earnings. That's why this is moving higher. That's what's freaking people out when they're looking at this and going, well, the MAC, or the RSI's up here, and this matters. But the fundamental story here is what matters more. So technicals are going to matter, and you're going to want to trade technicals, right? Technicals tell you when, right? Fundamentals tell you who. Okay, think about it that way. So if you look at it from that perspective, this is a completely different story right now, to the point that the analyst came out and actually said, everybody's got to throw away their models. All their models are obsolete. They have to start over. And we're seeing that, whether you want to believe that or not. Now, I think Oracle got way ahead of itself here, but when you have a company that's earning billions and billions of dollars and they're saying, oh, by the way, our cloud space is growing at 50% and we got $2 billion worth of orders, you need to pay attention to this. The one thing that I tried to make clear to everybody was if you want to get ahead of this game, and I'll say it again, go listen to Oracle's conference call. Go listen to the companies that are going to buy that $2 billion of capacity and go find out who their clients are, okay? That's how you get ahead of this stuff fundamentally, and it makes a huge difference. So I'm going off a little bit of a tangent here, but I really want people to understand this and how to play this stuff. Now, if you look at the SOX, that's a clear breakout. The only thing that's going to take this market down right now, in my opinion, besides the normal volatility of a market, is if Powell does something silly tomorrow. And I don't see it happening. I see breakouts. I see continued pushes right into this level. I don't see how you're not getting to 267 tomorrow. I don't see it. And then we go into Wednesday and you have Linear that's coming out and these home builders just look absolutely amazing. This thing's setting up to break out ahead of earnings. So I would watch that as well. And then I would take a look at things like Adobe. Adobe sold off today, and it makes a little bit of sense as to why it's ahead of itself. There's a lot baked into this quarter, so we're going to have to watch that. But what you're going to notice is rotation, and you're going to want to pay attention to that rotation. So this is something I traded today. We made like $6 on it. Now you're sitting there. Is this dead? No, it just came down. We're just rotating. And that's the word that you're going to have to get used to. We're going to constantly rotate, right? You're going to see this happen a lot to people where they're going to buy these names and think the stories are the same. This is something I shorted. If you were following us for a long time, this is something I shorted way back here when they did this bond offering, and it was short for a very long period. I covered the rest of it on this move because it became increasingly clear that if they could really get this together, that this stock can go a lot higher than I thought it was. It's certainly not going to be a zero if they're going to earn $6,000 a car. I didn't believe it at first, but it seems like when you start going through it that they might actually have that ability. Now, why is this important? Because you're breaking out here. And if you're short and you didn't cover, you have a problem. The same people that are short AI here, right? We're not going to get into just the technicals here. It's going to be the fundamentals. And the amount of money that is still on the sidelines is staggering. We'll go over that tomorrow. Make sure you tune in tomorrow and watch us live. We're going to do that from 2 to 3 tomorrow. Any questions, as always, reach out. Have a good night.